Okay, so you want to own a nightclub. You picture a dark room, a line outside, music shaking the walls, and a bar selling $20 drinks that cost $2 to make. On paper, it looks ridiculous. People pay to get in, pay again to drink, pay even more to skip the line, and sometimes pay the most for a table that mostly exists so the rest of the room can watch them pay the most. If you only looked at the markup on a bottle, nightclub ownership would seem like one of the easiest fortunes in hospitality. The problem is that a nightclub is not really selling alcohol. It is selling status, density, and the feeling that tonight matters more inside your room than anywhere else in the city. And that is a much more fragile product than most first-time owners realize. Because the moment the room looks slightly less full, slightly less exclusive, or slightly less relevant, the economics begin to change immediately. The rent does not care. Payroll does not care. Insurance definitely does not care. But the crowd does. And once the crowd moves, the money tends to move with it. That is what makes nightclub ownership so strange. It looks like a simple bar business with extreme margins. In reality, it behaves more like a weekly market for attention, where every Friday and Saturday the city votes on whether your room is still worth overpaying for. When the answer is yes, the money can feel absurd. When the answer becomes maybe, the decline can start faster than most owners are built to survive. So let us start with the first question. What are you actually buying when you buy a nightclub? Most people think they are buying a bar with louder speakers and better lighting. That is not really what a nightclub is. A nightclub is a short-duration, high-intensity cash extraction machine built around crowd psychology. It takes a fixed amount of space, fills it with as many people as the fire code allows, and then monetizes almost every social instinct in the room. The desire to skip the line, the desire to be seen, the desire to stand near the center of attention, the desire to make a purchase that other people can watch you make. In a normal bar, people are mostly paying for drinks. In a nightclub, they are paying for position. That distinction matters because it explains why nightclub economics can look so incredible from the outside. A cocktail in a neighborhood bar might cost $10 or $12. In a nightclub, the same drink can be $20, $25, sometimes more, and customers do not just accept, they expect it. A bottle of vodka that might cost the venue $30 or $40 wholesale can be sold for $600, $800, or over $1,000 at a table. In top-tier markets, premium table packages can go into the tens of thousands in one night. To someone who has never seen the books, it sounds like the closest thing hospitality has to legalized money printing. Buy cheap alcohol, sell expensive status, repeat until rich. The problem is what happens before opening night. Because nightclub ownership is one of the most front-loaded businesses in the entertainment world. The first cost is the location, and a nightclub cannot hide somewhere cheap. It needs to be where nightlife already exists, or where enough affluent people can be trained to show up consistently. That usually means entertainment districts, downtown cores, tourist corridors, or wealthy urban neighborhoods. The same areas that attract nightlife are also the same areas where rent is already expensive before you add alcohol, noise, and 2 a.m. foot traffic to the equation. And once a landlord hears the word nightclub, the economics usually get harsher. Nightclubs are high-risk tenants. They bring noise complaints, late-night damage, neighborhood opposition, lawsuits, police attention, and insurance headaches. So the landlord may want a larger deposit, stronger guarantees, tighter lease terms, and sometimes a higher effective rent than they would ask from a restaurant or retail tenant. You are not just renting square footage. You are paying for the right to create controlled chaos inside somebody else's building, and the person who owns that building knows exactly what kind of risk you are bringing with you. Then comes the build-out. And this is where a lot of first-time owners get hit by reality. A nightclub is not just a room with a bar and a DJ booth. It needs serious electrical work for lighting, sound, refrigeration, and point-of-sale systems. It needs industrial HVAC strong enough to cool a densely packed room full of moving bodies for hours. It needs reinforced restrooms that can survive sudden surges of hundreds of guests. It needs security cameras, exits, fire suppression, acoustic treatment, staging, booths, bottle presentation equipment, lighting controls, and enough finish quality to make expensive prices feel justified. Mid-sized clubs can easily spend $1 to $3 million getting to opening night. In top markets, the numbers go much higher. Hakkasan, Las Vegas, reportedly cost around $100 million to build, and that was not because the owners loved spending money. It was because in nightlife, the room itself is part of the product, And expensive rooms are often used to signal expensive experiences. Then there is licensing, which sounds boring until you realize it can determine whether the business exists at all. A nightclub without a liquor license is not a nightclub. In many cities, getting that license is not just a form. It is a political process. You may need zoning approval, background checks, police review, community board support, and public hearings where residents can object to the venue before it opens. In some places, licenses are capped in number, which means you are not applying for one so much as buying access to one. That can mean hundreds of thousands of dollars before you have served a single drink. So by the time your grand opening arrives, you may already be several $1,000,000 into the project. And only now do we get to the part everyone imagines first, how the nightclub actually makes money. The first stream is the cover charge. This is the cleanest money in the business because it arrives before the guest has consumed anything and before the venue has spent much labor on that individual customer. If 700 people each pay $30 at the door, that is $21,000 before the bar even starts moving. On a major event night, those numbers can go much higher. But cover is also one of the most fragile revenue streams because it depends entirely on perceived demand. The hottest clubs can raise cover and still build a line. Weak clubs end up waiving cover, discounting entry, or giving away guest list spots just to keep the room from looking empty. The second stream is the bar. This is where most people think the real money is, and to be fair, the margins are large. Spirits are cheap compared with the prices customers pay in a crowded room where convenience matters more than value. Beer, mixers, and simple cocktails can all be marked up aggressively. But the margin on paper is not the margin in reality. Bartenders overpour, staff give free drinks to friends, inventory gets mishandled, product gets spilled, some get stolen. Busy environments create leakage by default, and leakage is one of the reasons why a nightclub can appear to be printing money while quietly bleeding profit behind the scenes. The third stream is bottle service, and this is where nightclub economics become genuinely unusual. Bottle service is one of the clearest examples in business of customers paying primarily for symbolism rather than product. The alcohol matters much less than where the bottle is placed, how visible the purchase is, how attractive the section looks, and whether the buyer feels elevated above the rest of the room. A nightclub is basically slicing its floor plan into layers of status and selling each layer at a different price. General admission buys access. The bar buys speed. VIP buys separation. Premium VIP buys visibility. The most expensive tables in the club are usually not the ones that are most comfortable. They are the ones everyone else can see most easily. That is why the table math can look so extreme. A 10-person group may spend $3,000, $5,000, even $10,000 in one small section of the room. Not because they are consuming that much alcohol in any rational sense, but because they are buying the social theater around the alcohol. The sparklers, the bottle parade, the elevated platform, the crowd's attention. The perception that they are not just attending the night, but starring in it. For many successful clubs, a relatively small portion of the floor plan generates a wildly disproportionate share of the revenue because the room is not monetized by size alone. It is monetized by hierarchy. There is a fourth layer too, and people outside nightlife often miss it: sponsorships and brand partnerships. Liquor companies pay for placement. Energy drink brands sponsor events. Fashion labels host afterparties. Major clubs may secure pouring agreements, branded activations, co-marketing funds, and event support that add serious money over the course of a year. On top of that, clubs can monetize private events, celebrity appearances, holiday weekends, New Year's Eve packages, festival afterparties, and one-off buyouts. A normal Saturday might be profitable, but a holiday weekend can produce a completely different level of cash flow. For some venues, a handful of massive nights make a meaningful share of the year. So far, the nightclub sounds like an extraordinary machine. Cover, bar, tables, sponsorships, special events, multiple revenue streams all stacked into a few concentrated hours of the week. Now here is the other side of the ledger. Start with labor. A nightclub does not just need staff. It needs staff at speed in darkness inside a compressed, high-pressure environment where mistakes are expensive. Bartenders need to serve quickly enough to prevent long lines without losing inventory control. Barbacks have to keep product moving through crowded spaces. Hosts have to manage seating, table upgrades, and VIP arrivals. Security needs to control entry, break up problems before they become fights, monitor intoxication, and handle emergency situations. Then there are managers, cleaners, lighting operators, sound technicians, servers, support staff. and often outside promoters. The payroll is not spread smoothly across the week the way it might be in a hotel. It is concentrated into a few critical nights where operational failure is visible immediately. And in nightlife, labor is not just a cost. Labor is part of the product. If the bar is too slow, guests buy less. If the door is chaotic, the line outside looks disorganized instead of exclusive. If security is weak, risk rises immediately. If bottle service is sloppy, high-paying guests do not come back. A beautiful room can still feel amateurish if the operation inside it is not choreographed properly. That choreography costs money. Then there is talent. Music is not a background expense in a nightclub. It is often one of the venue's main pricing tools. A house DJ may keep costs manageable but may not drive demand. A recognized local name may cost a few $1,000s on a big night. A major touring DJ or celebrity appearance can cost tens of thousands for one evening. In some clubs, management is effectively buying demand by paying for names that make people feel the night matters. That can work, but it also means a full room with expensive talent may be much less profitable than a slightly smaller room with the right crowd and lower acquisition cost. And then we get to promoters, who are one of the most important and least stable parts of the entire business. Promoters do not just advertise. In many venues, they function as outsourced demand generators. They bring social circles, birthday groups, attractive guests, influencers, and the kind of bodies that make the room feel alive. Sometimes they are paid flat fees, sometimes per head commissions, sometimes a percentage tied to tables or bar spend. The exact deal changes, but the principle stays the same. A meaningful share of your crowd may not belong to you directly. It may belong to the promoter who can redirect it somewhere else next month. That creates a weakness hiding under the floor. A nightclub can appear to have real brand power when in reality it is renting momentum from a network of outside people. If a competing venue offers promoters better splits, better treatment, better table inventory, or simply newer energy, traffic can move surprisingly fast. The room may still be yours. The pipeline feeding it may not be. This is one reason some clubs look stable until they suddenly do not. The crowd makes the demand feel permanent. Very often, it is not. Then there is the problem of comps, which sounds small until you realize how much of nightlife depends on them. Free entry for attractive guests, free tables for celebrities, free drinks for people whose presence is expected to improve the look of the room, free guest lists for groups that make the club appear hotter than it really is. This is normal because atmosphere is part of the product and certain people are effectively being subsidized to help create that atmosphere. But comps create a dangerous illusion. A packed room may contain a meaningful number of people who contributed little direct revenue. They are there to signal desirability or to help convert spenders nearby. Sometimes that works beautifully. Sometimes it creates the appearance of success while quietly lowering the real yield per guest. This is the deeper point most outsiders miss. Occupancy is not the same thing as profitability. A nightclub can be full and still underperform. If too much of the room is there on discount, if drink spend per head is weak, or if the money is concentrated in fewer tables than expected. The right crowd is not always the biggest crowd. It is the crowd mix that makes everybody spend. Too many low-spend guests can dilute the room. Too few can make the club feel empty and over-curated. The owner is constantly trying to solve a social equation that changes every single night. And here's where the business becomes more fragile than it first appears. Because unlike an airport, a bank, or even a shopping mall, a nightclub's core product is not physical. It is relevance. The same room, with the same bar, same speakers, and same license, can produce wildly different financial outcomes, depending on whether the city currently believes that room matters. A nightclub is one of the few businesses where the customer is paying largely for the presence of other customers. That means demand is reflexive. People come because other people are coming. High spenders buy tables because the room looks desirable. The room looks desirable because enough attractive, connected, high-energy people are already inside it. If one piece weakens, the others often weaken with it. This is why nightclub decline can feel sudden even when the warning signs were building for months. The line outside gets shorter. Then the club starts leaning harder on guest lists to avoid looking thin. Then table minimums get softened quietly. Then promoters ask for better deals because the room is no longer doing the work by itself. Then high-value customers begin to notice that the club feels like it is trying too hard. The music still plays, the bar still pours, but the invisible pricing power that once allowed the venue to charge absurd markups begins to erode. And once pricing power erodes, the business reveals how expensive it always was, because all the fixed burdens are still there. Rent, insurance, security, labor, debt service, utilities, licensing, repairs, marketing, merchant processing fees, legal and compliance costs. None of those go away just because the club is less hot than it was 6 months ago. In fact, some of them rise, because declining clubs often spend more trying to force demand back into the room. More on talent, more on promoter, more on advertising, more on comps, more on cosmetic upgrades. The owner starts paying extra just to defend a revenue level the market no longer naturally supports. This is where a lot of nightclub owners get trapped. They mistake a relevance problem for a marketing problem. They assume more promotion can recreate social gravity. Sometimes it can for a little while. Usually it just makes the decline more expensive. Let us put rough numbers on that. Imagine a club doing $12 million a year in revenue. Maybe $4 million from tables, 4.5 from the bar, 1.5 from cover, and the rest from events, brand deals, and private bookings. Let us say the venue clears an 18% operating margin in a strong year. That is a healthy nightclub. Now imagine revenue falls by 20% to 9.6 million, because a competing venue opens nearby and your VIP demand softens. Costs do not fall by 20%. Rent is fixed. Insurance is fixed. A lot of payroll is semi-fixed. Security and utilities may shrink a little, but not nearly enough. What was a healthy profit can collapse into break even or worse very quickly. That is the trap. A modest decline in perceived relevance can produce a disproportionately large decline in actual profit. And nightlife has another hidden pressure that most new owners do not think about enough: maintenance. Drunk people are hard on buildings. Floors get scratched, upholstery gets torn, fixtures loosen, bathrooms take a beating, lighting systems fail, refrigeration breaks. The room physically ages much faster than many owners expect. In another kind of business, cosmetic wear may not matter much. In nightlife, cosmetic wear can be interpreted as market wear. If the booth leather looks tired, if the entrance moment feels dated, if the lighting design looks old, the city does not say your capex budget is under pressure. It says your club fell off. That is why many venues end up in a reinvestment cycle that behaves almost like an industrial asset. New signage, new layout, new booths, new lighting package, new DJ programming, new visual identity. Sometimes the room itself barely changes, but management knows the story around the room has to change, or the market will write a new story for them. The cruel part is that a club may need to spend major money at exactly the moment cash flow is getting weaker. There is also legal risk, and this is where the nightclub business becomes less glamorous very quickly. Intoxicated guests fight. They fall, they drive, they post videos, they bring unwanted attention. In many jurisdictions, if a visibly intoxicated guest leaves your venue and causes serious harm, the nightclub can end up in a lawsuit worth far more than it made from that person in a lifetime. Add underage risk, fake IDs, noise complaints, overcrowding issues, and occasional police scrutiny, and you begin to understand why insurance for nightlife is so expensive. A serious incident can become a lawsuit, a licensing issue, and a public relations problem all at once. Keep that in mind if you ever think a line outside means a safe business. The line tells you people want in. It does not tell you whether the economics underneath are healthy, whether the compliance is airtight, or whether the owner is one bad weekend away from real trouble. A famous example of this disconnect was Studio 54. It opened in New York in 1977 and almost immediately became one of the most famous nightclubs in the world. The line outside became part of the mythology. Celebrities, models, musicians, financiers, everyone wanted in. By the end of its first year, reports suggested it had generated millions in revenue, making it one of the most successful clubs of its era. From the outside, it looked untouchable. But beneath the glamour, the operation was not nearly as secure as the crowd believed. Federal investigators eventually raided the club, tax charges followed, and its founders, Steve Rubel and Ian Schrager, ended up pleading guilty to tax evasion. The crowd was real. The demand was real. The line was real. The business underneath it was much more fragile than the mythology suggested. That story matters because it shows something people routinely misunderstand about nightlife. Popularity and durability are not the same thing. A club can be famous and still be poorly structured. It can be packed and still be overexposed. It can have incredible sales and still be one regulatory problem, one legal problem, or one relevance problem away from decline. Studio 54 did not fail because people suddenly stopped wanting to party. It failed because nightclub businesses are exposed to more than demand. They are exposed to everything that comes with managing dense, intoxicated, high-profile crowds in expensive spaces under public scrutiny. Modern nightlife has its own version of the same lesson. In cities like Las Vegas, Miami, London, and Dubai, clubs are routinely renovated, rebranded, or replaced after only a few years, even when they were once major successes. That is not because the owners got bored. It is because the product ages culturally faster than it ages physically. A room that felt elite in year one can feel familiar in year four. And familiarity is dangerous when your whole business depends on charging a premium for urgency. This is why the most sophisticated nightclub operators rarely think like small bar owners. They think more like portfolio managers of attention. Groups such as Dow have operated multiple venues across multiple cities because diversification matters here. One independent club in one market is a concentrated bet on local taste, local regulation, local promoters, local weather, local seasonality, and local competition. A portfolio can survive weakness in one venue with strength in another. Vendor terms improve, talent relationships improve, marketing becomes more efficient, customer databases become more valuable. Scale does not remove the core problem, but it spreads the risk. Even then, the risk is real, because the room itself can create false confidence. When you are standing inside a packed venue watching servers run bottles and hearing constant music, it is psychologically difficult to believe the business might be weak underneath. It feels alive, it feels monetized, it feels important. That is why some owners stay in too long. They trust the energy more than the numbers. But energy does not pay quarterly tax bills. Energy does not service debt. Energy does not cover rising insurance premiums or legal fees, or the cost of replacing a failing cooling system in July. There is another trap too, and it is timing. Nightclubs do not earn money evenly. They earn money in bursts: Friday, Saturday, maybe one strong weekday depending on the city, maybe a holiday weekend, maybe New Year's Eve, maybe a festival after party. A meaningful share of annual profit can be concentrated into a surprisingly small number of nights. That makes the business vulnerable in a way many other businesses are not. Lose the big nights, and you may lose a huge slice of the year's earnings with no simple way to make it back later. Seasonality makes this worse. Tourist markets rise and fall with travel patterns. College markets rise and fall with the academic calendar. Coastal markets rise and fall with weather. A few weak months can matter enormously when the cost base is high and the revenue base is concentrated. Economic downturns hit in a very specific way too. A nightclub can still look busy in a weaker economy, but that does not mean the room is healthy. Sometimes the first thing that disappears is not attendance. It is premium spend. A customer who once bought a $5,000 table now buys a $2,000 one. A group that once ordered 3 bottles now orders 1. The room stays loud. The economics quietly weaken. And then 2020 showed what happens when nightlife loses the one thing its model depends on: dense, shared, late-night physical presence. Nightclubs were among the first businesses forced to shut down and among the last permitted to fully reopen. Revenue did not slowly decline. It dropped to zero. But the structure underneath remained. Rent still existed. Insurance still existed. Debt still existed. In some cases, staff obligations and compliance costs still existed. Some venues survived because they had reserves, outside capital, or landlords willing to negotiate. A lot did not. The pandemic did not create nightlife's fragility. It just made it impossible to ignore. So does owning a nightclub actually work as a business? In the optimistic scenario, yes. You secure the right location. You control build-out costs. You get the licensing right. You design the room intelligently. You manage the crowd, mix well enough that high spenders want to be there, and the general room still feels alive. You keep inventory tight. You avoid major incidents. You maintain strong promoter and talent relationships without becoming totally dependent on them. You capture enough VIP demand to make the floor plan work. In that world, the margins can be excellent. A successful nightclub in the right market can generate returns that look extraordinary compared with an ordinary bar or restaurant. In the pessimistic scenario, you overpay to build the space, open into a crowded market, rely too heavily on discounts to create buzz, depend on outside promoters for traffic, underestimate insurance and labor, and assume the room will stay hot longer than it actually does. Then a newer club opens, or the economy softens, or one ugly incident damages your reputation, or the city tightens enforcement, or your best spenders quietly migrate to somewhere that feels fresher. Now you are defending yesterday's cost structure with today's weaker attention. That is when the glamour disappears and the math takes over. This is the honest truth underneath the whole business. A nightclub is not really a bar. It is not really a music venue either. It is a machine for converting social urgency into high-margin purchases for a few compressed hours at a time. When the urgency is real, the economics can be incredible. When the urgency fades, the same room becomes one of the most expensive kinds of empty real estate in the city. So, if you ever do decide to own a nightclub, understand what you are actually buying. You are not buying liquor inventory. You are not buying speakers. You are not even buying nightlife in the abstract. You are buying a temporary claim on relevance in a competitive market where relevance decays quickly and costs stay stubbornly real. When it works, everybody notices the spending. What they do not notice is how much of that spending depends on a social illusion staying intact week after week. And that is why nightclub ownership is one of the strangest businesses in hospitality. The margins can look insane. The cash can move fast. The room can feel invincible. But underneath it all, the model rests on one unstable assumption, that enough people will keep believing that tonight matters most inside your doors. The moment that belief weakens, the music may still be playing, the lights may still be flashing, and the bottles may still be cold, but the economics have already started turning against you. And if you think that is a brutal business, wait until you see what happens when the thing you are buying is not a room full of attention, but a building full of debt, elevators, and empty floors. Okay, so you want to buy a skyscraper.